Did you know Australia's hidden inheritance tax on super could see the ATO take up to 32% of your balance when it's passed to your adult children? In this video, I'll break down how this hidden inheritance tax works, share 3 powerful strategies to reduce or even eliminate it, and walk you through real examples showing how the right moves could save tens of thousands. If you are retired or getting close and expect the money inside your super could one day be passed on to your adult children when you're gone, this is a video you don't want to miss. So what actually happens when we pass away and still have money inside super? That balance doesn't just disappear, it has to be paid out as what's called a super death benefit. That payment can only go to the deceased estate through the deceased legal personal representative. From there, the distribution is handled according to the instructions in the will, and/or one or more of deceased 6 dependents, which include a spouse or de facto spouse, a child of any age, a financial dependent, or a person who was in an interdependency relationship with the deceased at the time of death. The term cis dependents refer to the group of individuals who can receive a superannuation death benefit directly from the super fund. But when we want to know whether tax applies to the payments they receive, we need to look at a different list called tax dependents. Superannuation death benefits paid to tax dependents are completely tax-free, but it's a different story when the beneficiary is a non-tax dependent. As you have probably noticed, a financially independent adult child doesn't qualify as a tax dependent. That's when the hidden tax trap really comes into play. The amount of tax payable depends on the makeup of your super balance at the time of death. A super balance is divided into 2 tax components, the tax-free component and the taxable component. The tax-free component comes from after-tax contributions, such as non-concessional contributions, government co-contributions, or spouse contributions. This portion is always tax-free, even when it's paid to non-tax dependents, such as adult children. Within the taxable component, there are 2 elements, the taxed element and the untaxed element. The tax element comes from employer contributions, salary sacrifice, personal deductible contributions, and investment earnings that have already had some tax paid inside the fund. For most people, this makes up the bulk of their balance. If this is paid to a tax dependent, it's tax-free. But if it's paid to an adult child, it's taxed at 15% plus the medical levy, bringing the total to up to 17%. For example, if 400,000 of your balance is in the tax element, your adult child could lose around $68,000 straight to tax. The untaxed element usually comes from insurance payouts or certain untaxed super funds. If it's paid to a tax dependent, it's tax-free. But if this portion is paid to an adult child, the tax rate is much higher, 30% plus medical levy, so up to 32%. Building on the previous example, if your super also included another 200,000 in the untaxed element, that would mean additional tax bill of about $64,000. Put together, your adult child could lose 132,000 of the 600,000 super balance to tax. If you only have just become aware of this tax, I completely understand. There are 2 honest reasons why this often goes unnoticed. First, it doesn't affect you while you are alive. Once you retire, everything you draw from super funds are tax-free, so these tax components don't affect you personally as the owner of the super fund. Second, these tax components don't even show up on regular super statements. There's nothing there to even spark curiosity or make you wonder how they matter. To know the breakdown, you have to call your super fund and actually ask for it. Unfortunately, the superannuation death benefit tax often only comes to light when adult children are hit with a tax bill. Many families simply accept it, not realizing there were ways to reduce or even avoid this tax altogether. One of the most widely used strategy is the recontribution strategy. This is best understood with an example, but before that, a quick disclaimer. This video is for educational purposes only and is not financial advice. Even if your situation sounds similar to the examples I'm sharing, it's important to do your own research or speak with a qualified professional before making any decisions. Meet Josh, who is 65 and retired in June 2025. At that time, he had a super accumulation account with a balance of $600,000, consisting of a $100,000 tax-free component and a $500,000 taxable component tax element. His only beneficiary is his adult son, Dave, who is financially independent and therefore considered a non-tax dependent. If Josh were to pass away and his super were paid directly to Dave, the $100,000 tax-free component would transfer tax-free. However, the $500,000 taxable component would be taxed at 15% plus the medical levy, meaning Dave would lose around $85,000 to tax. But this tax could have been significantly reduced if Josh had implemented a recontribution strategy. Here's how it works. Step 1. Withdraw from super fund tax-free. Josh is 65 and retired, which means he meets the retirement condition of release. As a result, there is no upper limit on how much he can withdraw from his super, and any withdrawals he makes are completely tax-free. These are ideal conditions for starting a recontribution strategy. So right after his retirement in June 2025, Josh took out $480,000 from his super. It's important to know that any lump sum withdrawals or pension payments from super follow the same proportion of tax-free and taxable components as the overall balance at the time of withdrawal. So when Josh withdrew $480,000, 16.7% or $80,000 came from the tax-free component, while 83.3% or $400,000 came from the taxable component. That leaves Josh with a remaining super balance of $120,000, consisting of $20,000 in the tax-free component and $100,000 in the taxable component. By the way, if you like to follow along with the calculation or try it with your own numbers, I have created an Excel template for you to download. Just check out the link below. Step 2. Recontribute the same amount as non-concessional contributions. Think of this step as washing the money clean. The amount Josh withdrew earlier was a mix of tax-free and taxable components, but by contributing it as non-concessional contributions, the entire amount becomes tax-free going forward. I'll show you how Josh was able to contribute the full $480,000 in a moment, but first let's take a look at the result. After this, Josh's super balance is still $600,000, but the tax-free component has increased from $100,000 to $500,000. In percentage terms, that's a jump from 16.67% to 83.33%. If Josh were to pass away later and his super was still around $600,000, Dave would only pay tax on that $100,000 portion. At 17%, the tax would be just $17,000 instead of the original $85,000. That's a saving of over $68,000 in tax. Now let's walk through how Josh was able to contribute the full $480,000 back into his super. In June 2025, Josh contributes $120,000. That uses up his annual cap for non-concessional contributions for FY25, but doesn't trigger the bring forward rule. Then, just after the start of the new financial year in July 2025, he contributes another $360,000. This time, the 3-year bring forward rule is triggered, letting him use 3 years worth of contribution caps at once. By doing this, Josh is able to contribute the entire $480,000 in a relatively short period of time, and importantly, it all goes back in as tax-free component. Of course, how much you can contribute depends on your individual circumstances. If you'd like to learn more about non-concessional contributions and the 3-year bring forward rule, check out my dedicated video on that topic. Step 3 for Josh is to use the money in his super accumulation account to start account-based pension. At the time the pension starts, the proportion of tax-free and taxable components is locked in. It's worth noting that the recontribution strategy isn't a one-time opportunity. That 17,000 tax could be reduced even further by using the same strategy in future at the right time. Another way to reduce super death benefit tax is having super paid through the deceased estate instead of paying directly to adult children. Let's get back to Josh and Dave. If Josh's super were paid directly to Dave, not only would Dave face up to 17% tax on the taxable component, but the lump sum would also be counted as assessable income in his personal tax return. A sudden spike in assessable income can have flow-on effects across many other areas of Dave's finances. He could be hit with Medicare levy surcharge if he doesn't have private health insurance, face Division 293 tax, and be required to make higher compulsory HEX repayments, all while potentially losing access to various tax offsets, the family tax benefit, and the childcare subsidy. But if Josh's super was first paid into his estate and then passed on to Dave, the Medicare levy doesn't apply when the payment goes through the estate. The estate can use the general tax-free threshold to reduce the tax on the taxable component. Dave doesn't need to include the death benefit in his own tax return. That means it won't push up his income and won't trigger all those flow-on effects we discussed earlier. Overall, having the super death benefit paid to the estate rather than directly to the beneficiary can potentially reduce the tax bill and help avoid many of the negative flow-on effects. That said, it's not always just about tax. Money paid through the estate might take longer to be distributed, and in some situations, it could be exposed to disputes over the estate. So it's important to weigh up the broader implications. Definitely seek advice if your situation is not clear-cut. Strategy number 3, avoid super death benefit tax by cashing out super just before death. Once the money is withdrawn, it's out of the super system and no longer subject to the superannuation death benefit tax. It simply becomes part of your estate, dealt with under your will, and there is no inheritance tax on that. The tricky part is timing. Not everyone can predict their death. Take the money out too early and it loses all the protections and concessions of super, which can mean more tax, reduced Centrelink benefits, complications with estate planning, and even a higher risk of family disputes over the estate. Leave it too late, you could miss the chance to use the simple strategy to eliminate death benefit tax. So while cashing out super before death can wipe out superannuation death benefit tax, it comes with risks and complexities. So it's best to seek professional advice if you're considering this path. If you found this video helpful and want to dive deeper, check out my other videos on superannuation and the age pension. That will give you even more strategies to make the most of your retirement money. Thanks for watching, I'll see you in another one.